Hello, everybody, and thanks for tuning in today. I'm really glad you could join us. So today we are talking about how to properly manage your money. We want to be able to get the most amount of money possible from the money earning in your business. And a lot of things have changed right now with COVID-19. It's a different world. So a lot of the strategies that a lot of people were trying to follow before this really become different when it comes into us pushing into a recession. And so with us today is one of the foremost experts, Douglas Stone. Now, he's actually a wealth management advisor who left his gig at a major wirehouse just a few years in, once he realized that his industry wasn't helping its customers the way they really needed to be helped. And he became an independent advisor and has been committed to helping clients, especially business owners, make the best financial decisions ever since. And his best-selling book, Navigate the Investment Jungle, 7 Common Financial Traps and How to Sidestep Them, Doug is teaching the common financial mistakes he's seen so many clients make. As he points out in the book, most people don't even realize they've fallen into those traps until it's too late. So we're going to talk about how to not fall in those traps and how to get out if you already are. Many folks think that because they have a financial advisor look over the report that they're in good shape. But Doug says that a shit is a huge trap in itself. In reality, many advisors don't have a fiduciary duty to their clients and therefore might not have their best interest in mind. Doug, welcome to the show today.
Pleasure to be here. Thank you, Ty.
Well, I'm really glad you've got a lot of experience in this area, and I've seen a lot of what you're doing, which is why I wanted to have you on in the COVID and how you're helping people navigate this crisis. So just kudos to you helping so many people through all this.
Yeah, well, let me just kind of back up. What really the COVID pandemic really did expose is how modern portfolio theory just really has some big holes in it. And what's happened to our industry is we're pretty much all trained the same way. And what we found over the years, at least I found, is that doesn't really work. And what happens is a lot of people found that out, especially business owners, and how that kind of relates to what we're talking about. So let's give, for example, you're a business owner and you've got 10, 20 million of capital tied up into your business. And obviously you've got that capital at risk in the market. That's capital risk. And so on top of that, they go down to their advisor. Maybe they have a million or two in the market, and their financial advisor says, well, we need to get 60, 70% of your portfolio back into the market. Well, now you've just exasperated your risk. So what happens, and it's a common mistake that people make, so what happens is now you've got a tremendous amount of risk in the capital markets, whether it be business risk or assets or whatever the case may be. And the whole idea is, when you become successful, is change that mindset to, let's look at how we can protect that capital for our later years, whether we have a liquidity event or whatever that may be. How can we preserve that capital for the long run without taking any extra risk than we need to take? And that's a really common problem that I see.
Yeah, and you mentioned specifically the modern portfolio theory, but I think a lot of people tuning in aren't familiar with what that is. So talk about what the modern portfolio theory is.
Okay, basically it was devised back in the 40s by Harry Markowitz, and he was a professor at a university, and he basically posed the question to his class, let's do this. Is there a way we can set up and predict the outcome of our portfolio? And what they came up with, yes, we can, and it's based on how we allocate our money into the markets. And I point out, obviously, it's a theory. So what happens is it doesn't always work. And like I mentioned before, by doing this and placing a large amount of capital in equities, for example, you expose yourself to a tremendous amount of risk. So for example, let's say back in March and April, when the markets were declining rapidly, all you had to do was look at your portfolio and say, is my portfolio tracking that drop in the markets? Or conversely, am I properly diversified? And so when I say diversification, what I really mean is every single asset in your portfolio either works in opposite of the market or in tracks the market down, up or down. So what you want to do is, and I see this mistake pretty commonly, most people, even advisors, I hate to say, spend all their time and energy focusing on how we allocate the capital instead of how do we allocate risk. And that's a really big difference between those two things. And so that becomes the problem.
There's a lot of flawed assumptions around this. Just you mentioned some as we got started, but what are some of the others?
Okay, so here's a couple that, first of all, there's 4 basic assumptions that I believe are incorrect. Number 1 is that the markets are efficient. Well, I pose if that were the case, then every single day, every stock traded on the exchanges would be priced at fair value. That's not the case. Rarely the case. Number 2, people act rationally. That's the other 4th or 2nd false assumption in the capital markets on modern portfolio theory. Number 3, and I won't spend a lot of time on people acting rationally because we know they don't. And number 3, that risk is static. In other words, it stays the same and over time, and it just doesn't do that. It changes on a daily basis. And so those are the 3 big ones right there that really cause people to have a problem in how they set up their portfolio by making those assumptions that those risks are just there and they'll always be the same. Here's an example. Back in the 70s and 80s, people put a lot of what we call defensive stocks in their positions, like utilities, power, water, those kind of things that we all use on a regular basis. Today, in those particular sectors, they're more closely tracked to the equity markets. In other words, they follow up and down whatever the markets are doing. That's not what you want. You want things that go in reverse of that. So if the markets are falling, you want that position to go up. And as the markets become more complex, those things are harder and harder to find, but they're still out there.
What are some of the other mistakes, outside of falling into this trap with these, the flaws in the modern portfolio theory? What are some other mistakes that you see a lot of business owners making?
I think a lot of people don't understand their fees, what they're actually paying for the advice and the investments that they have in their portfolios. For example, and I mentioned this in the book, that Dalbar study and a lot of other ones did a lot of independent research on this. The average investor, if they have mutual funds, pays about 4% per year for those mutual funds. And the majority of people don't even know that that's the case. That's why 90-some% of mutual funds don't even match their benchmarks. So you could be saying, well, I'm getting pretty good returns, so I'm happy. Well, they could be taking, the mutual fund company could be taking up to 60% of your returns and you don't even know it. That's a really common one. Most people don't understand the difference between how and what those things are charged. For example, mutual funds have like 28 different potential fees that they can charge. The most blatant one is the SEC doesn't require them to disclose what their trading costs are per that fund, and they run on average about 1.4% per year. Then you start adding 12B1 fees, management fees, auditing fees, and all these other fees just load up on top. That's why we come up with the 4%, which is substantial.
Outside of fees, Doug, what do you see? And your whole book was on this topic, so I think there's a few more we haven't dove into. What are some other traps outside of just not really understanding the fees, and then therefore not really understanding the returns they're going to get if you can't take into account the fees, which is even bigger problem.
And that's a really big problem for people because they don't understand how those fees drive or take away from their returns. Another critical one we just mentioned a few minutes ago is properly diversifying your portfolio. A lot of people believe, well, I've got 60 different positions and they're all in different places in the market, therefore I must be diversified. Not true. If you watch the markets and those positions rise and fall with the markets, that means they're more closely correlated, which just means that they follow and track the overall market. If you had an S&P 500 index fund, for example, your standard deviation, or in other words, average from the middle, the mean, is about 15%. That's big. If you had a good high quality US Treasury, long-term Treasury, for example, your standard deviation is 4. So what people get confused about is I need to have a lot more risk to have good returns. That's not the case. If it's set up properly, you can still have very good returns and reduce your downfall significantly. And that's what institutional people do. These pensions and endowments and big, huge corporations, that's how they invest. A couple of my mentors would be Ray Dalio, which runs the biggest hedge fund in the world, which Bridgewater, and David Swenson that runs the Yale Endowment portfolio. They average 16 to 21% over the last 20, 30 years. So you're getting great returns, and they only have like 20 to 30% in the US equity markets. So that's the thing. We've all been brainwashed by the financial media saying we need to have 60, 70% of our money in equities in order to make a decent return. That's not the case.
Is that why so many people you think get sucked in and fall in these traps?
Absolutely, absolutely. And then we've heard these little sayings over and over again, like, you know, like your advisor may say, oh, hang on, you've got a great portfolio, just hang on to the boat, you'll be fine. Well, we all know the construction of the boat is really, really important. The famous example is the Titanic, which was, you know, promoted to be unsinkable, and yet it sits at the bottom of the ocean. Well, you've got to prepare yourself for corrections like we've had, pandemics that we never see, all those kinds of things. You've got to have things in your portfolio that protect you, the investor, from those kinds of market collapses. And most people do not. That's just the fact.
If people have fallen in one of these traps, how do they get out?
You've got to have a better strategy. You've got to have a better system. If you keep, the old saying, you keep doing the same thing and expect a different results, you're not going to get it. So you've got to come up with a different strategy. And that's why I did that my own way back years ago when I became an independent advisor. I adopted the institutional model because it just plain works. And a lot of advisors don't know that because they're trained a certain way, and that's using the modern portfolio theory of allocating money. And when I was, and I clearly say in the beginning of the book, I drank the Kool-Aid because I thought, oh, how great it is to be in this world and help people manage their money. Then I realized that the things I was being taught wasn't working. And then you've got to take a step back and go, wait a minute, if this isn't working, there must be a better way. And there is. And you've got to have that self-discovery though, first, instead of making excuses to people and say, oh, just hang on, we'll get through it, we'll get back. And the rub is, and part of the trap is, these things are partly true sometimes. So you could have a 60, 70% portfolio. In the last 10 years, you did exceptionally well until we got into the pandemic. How did you do then? That becomes the problem. We get sucked into these things and we don't really know how to get out. Well, you get out by having a different strategy. And I propose the institutional model.
How does the institutional model work?
Very similar. You just allocate your risk differently. So you have some commodities, for example. You have some other highly more efficient equity exposure, like exchange traded fund, as opposed to mutual funds. So therefore you're cutting your costs back. You have things in your portfolio that high quality government bonds, for example, that actually go up when markets go down, those kinds of things, and just how you reallocate your money into those kinds of positions. And there's a few more, of course, but alternative investments and so on and so forth.
So give me a comparison, like the modern portfolio versus the institutional model. Give me some comparisons, like how are these two holding up right now through COVID?
Oh, very well. Well, again, the institutional model is holding up significantly better and did when the market collapsed because they didn't have the high allocation of equities exposure. And of course, this is another part of that trap is you go, well, yeah, but I had 60, 70% of my portfolio in equities, but I'm already back to where I was. Well, that may be true for you, and that's very lucky for you, but it doesn't always work that way. That's how we get sucked into these things. We go, oh yeah, I survived 2000 when the NASDAQ collapsed. I survived the financial collapse. Well, at some point in your investing life, you're going to run out of time where you can't afford to make those kinds of mistakes. And I work with a lot of business owners, and I tell them, why would you want to take that kind of risk anyway? You've already been a success. You've already made your money. Why would you want to take an additional risk in the market when you don't need to? It's that simple.
You left a big company, it sounds like, and then said, this isn't working, I'm going to go on my own. But, there's plenty of people like me out here where we're just out here doing what we love. We don't know. We trust the people in your position and in the position, the company that you left, to tell us. So how do we figure this out? How do we find the right person when everybody seems to have a strategy that they believe is the best? What do we do? Like, how do we figure out the right way?
Well, that's a great question, Ty, because really what it comes down to, you want somebody on your team that has a fiduciary responsibility. In other words, they've got a legal responsibility to put your interest ahead of their own. I would start there, number one. Then, based on you want to ask really good questions like, show me some of your portfolios and how they performed back in the 2008 and 9 financial collapse. Show me that. I'd like to see those. I want to see how you did then. If you were down 30, 40%, I would argue that that's probably not something you might be interested in, especially as we become older. So you've got to ask really good questions, then ask them how they get paid. That's a really good, important thing, because you don't want a conflict of interest. In other words, I'm recommending to you a certain product, and I know I may be getting 4 or 5, 6% commission on that product. Well, is that in your best interest? Maybe not. But you've got to ask that question, and you've got to give examples so that you know. So that's why I say, if you start with a fiduciary, you're on the right track, and then dwindle it down from there. And so that becomes really important. And because I work with a lot of business owners, and I like what we call the family office approach. In other words, all of these things are custom made to and for the client. And so it's not a one size fits all kind of thing. They're custom made because every single person has a different set of values and goals and approaches. And listen to the type of questions that you're being asked. That's when you really know, does this person really have my values and my goals and my best interests? What kind of questions are they asking me? Are they asking me about what my charitable interests might be? Are they asking me, what are my goals? How do I feel about money? What are my biggest fears in the market or in my business going forward? Those kinds of things, you get to build an emotional connection with your client, and that's what we do here. So So we truly have their best interest in mind and at heart because we know them very well, intimately. And that's lacking in most of the cases.
You mentioned this indirectly, I believe a couple times, but just to ask you directly, fiduciary, difference between working with a fiduciary, difference in not working with a fiduciary.
Yeah, basically, and the laws have changed a little bit now with the 401k laws. They're requiring a lot of what we call brokers to have that fiduciary responsibility because people have been ripped off over the years and years and years. So they've made that stipulation. But that hat only comes on when you're talking about the 401k business. It's not on their personal business. So there's a big gap there still that needs to be corrected. In fact, when we had the financial collapse, there was actually a committee. I find this just amazingly obnoxious and sad, but there was a committee that was put together that they wanted to study whether or not it was in the best interest of investors that we pursue that. Why would you not want a law that says we need to treat our clients and have their best interest at heart always? I mean, I find that amazing that we even have to have that conversation, but here we are. So it's just a different approach. It's just a different way of doing business, and it's all client focused. That's really the difference.
What about if somebody's already in the wrong strategy? They're at the bottom right now because everything bottomed out. What do they do? I mean, you mentioned getting a new strategy, but now you have a new strategy, a new path to go. But we're also taught that you don't want to pull out when things are at the bottom. So, what do you do?
Well, you may at that situation, you may have to just wait until the market recovers enough to where you can make another move. So the idea that is like anything else in business, we have to learn from our mistakes. And if we're not learning, then we're going to make the same mistake over and over and over again. And so you may have to wait until your portfolio gathers that synergy and that steam back. And that's unfortunate. And that's why I wrote the book, to help people so that they don't fall into those traps, so that they're not stuck and have to postpone their retirement 2 or 3, 4 more years because they can't get out at that particular point. And that's a sad part.
What's the best way to track the progress of your investments, basically your wealth, to see how things are doing?
That's a great question. Most people sort of forget this, but your net worth really drives your retirement. And that net worth, of course, is compiled with all of your assets, whether they be business or personal banking statements or brokerage statement, whatever that may be. You have to have a plan in place to say, I need to be here in point, B in 5 years. Well, if you're not on track to do that, then I would submit that you're in the wrong place. I mean, as business owners, we all have a marketing plan, a business plan, and we pretty much know what we want to do. Well, same thing applies in your investment side. If you're watching your statements and they're falling dramatically because the market is, I would submit to you that you're probably taking more risk than, number one, you're comfortable with, because nobody likes to see that. That's painful. And number two, you've got the wrong strategy. So it's a double-edged sword, really.
Makes sense. What do we look for? I mean, now we're going out. I think we have an idea of wrong strategy versus right strategy, how to get out, avoid some of these pitfalls. But how do we do it right? Like, there's a lot of people right now that are just looking to get started with investing. They have money. Their businesses are doing well. They're looking to do it the right way. What are the steps we take to find the right path for us?
Well, I would say, again, start with a fiduciary, a registered investment advisor, independent advisor that, and there's some really dramatic differences. So example, like here, we use Charles Schwab institutional platform to custodial our clients' money. The difference between that and a brokerage firm, for example, where whether it be a Merrill Lynch or a Morgan Stanley or all the other big ones, Goldman Sachs, is they actually house their money at their firm. So that's how you know it's a brokerage firm. A independent advisor will use a third party, non-affiliated brokerage firm to custodial their money. So that's a big difference right there. So that's an easy one to sort of say, where would my money be held? Well, they'll be held here at Morgan Stanley and you can see it, blah, blah, blah. As opposed to my funds are held at Fidelity or TD Ameritrade or Schwab Institutional and those kind of things. And the reason that's important is like on our platform that we use, our accounts are guaranteed up to $600 million, not 250,000. That's a big difference there. So you want to, and that all came about because of the Bernie Madoff thing. You know, people want to know that their assets are secure. Things are done outside, so it's not all internal, which was going on during the Madoff scandal. Because they could come up with their own reporting system. They could come up with, and I'm not saying these firms are crooked by any means. I'm just saying, if you want to do it right and get something custom made for you, you have to take a little different approach. And I think that approach starts with a registered independent advisor, because they've got your fiduciary responsibility is they've got a legal duty to protect you and put your interests ahead of their own, which is important, I think.
Sounds it.
Yeah.
What about insurance? I hear a lot about insurance from financial advisors, all different kinds of insurance, including captive insurance. So what's your take on insurance, and how should insurance fall into somebody's portfolio? And give me some insight on captive insurance as well, if you don't mind.
Captive insurance is really for only sort of large businesses that are paying a lot of money, like I'll say over $1 million in insurance. Either it be health insurance, disability, whatever the case may be. And so what you can do by paying out those vast amounts of premiums over the years and not getting anything back, you basically set up a captive insurance is basically you're self-insuring. You set up with minimal costs, your own insurance company, you deposit that same $1 million, for example, in that particular account, and then they're paid out. The difference is it's a huge tax advantage for you to do that, and your capital can grow over time. So if the initial outlay may be large, but as time goes on and the markets go, and you want to invest that money conservatively, obviously, but that money then grows, so your out of pocket becomes less, not to mention the huge tax deduction that you have for that. It doesn't work for everybody. You have to have really high premiums and some other things you might have to hoops you need to jump through. But for some people, it works really, really well.
Doug, thanks for coming on with us today. As we get ready to wrap up, what's some parting advice, maybe something I haven't asked you that you think is good for anybody listening and watching that's looking to basically get the most out of their portfolio?
I think really understand what you have invested in and why. That there's a lot to this that people just really don't understand. They think they might understand, for example, but there's a lot to it. And the really key thing I would say is have an exit strategy and have the proper diversification in your portfolio. So like I said, having a lot of things doesn't mean you're diversified. It's like if you own 5 houses, you've got 5 houses in the real estate market, you're not diversified. You may be in different locations, that's good, but if the housing market collapses, you see what happens. So that controlling and managing the risk is really, really important. Really important.
Where can everybody go to be able to learn more?
You can go on to Amazon, buy the book. It has all my contact information there. You can go to my website, navigatetheinvestmentjungle.com. I've got some free articles and some things there. That Forbes article is there, or will be there as well. That just came out here a week or two ago, and haven't had a chance to add that. And so it has all that contact. Or you want to just give me a quick email, I'm happy to talk to you, no charge, free consultation, dstone@seacrestwm.com, and reach out. I'd love to talk with you.
You said investmentjungle.com?
Yeah, navigatetheinvestmentjungle.com.
Okay, so navigatetheinvestmentjungle.com. I want to make sure I get that right. Okay, and I want to put a link to your book on our show notes page as well. All right, Doug, thank you very much for coming on with us today.
Thank you, Ty. Enjoyed it.
So everybody, look, this is a big deal because the reality is the vast majority of us as entrepreneurs think that we are going to hit a home run when we exit and sell our business. And the reality is a very small percentage of entrepreneurs ever really accomplish that feat. So if you're like me and you like to make, wise investments, you should be investing in planning your retirement even if you don't sell your business. That's something you should be doing by putting money aside every single month, by studying strategies like profit first, by pulling out your money first, and then investing it smartly. And as Doug said, there's a lot of cool advice today to teach you how to exactly go about falling out of traps and how to do it smartly. But we're on here for 30 minutes, right? We only got a smidgen of the information that Doug has to share, especially in his book. So make sure you visit navigatetheinvestmentjungle.com. That's navigatetheinvestmentjungle.com to get a bunch of tips and tactics to do this the right way, to maximize your return. You got one shot in life to do this the right way. And if you do it the right way, then you end up with a retirement you want. But if you don't, like so many, you don't end up with what you want. So do it the right way. Go to navigatetheinvestmentjungle.com, get a bunch of cool stuff. Make sure you grab Doug's book. I'm also going to make sure that book link is available on our podcast show notes page as well. Thanks everybody tuning in. Make sure that you visit navigatetheinvestmentjungle.com.